Welcome to the deep dive. Today, we're going straight back to maybe the most intense financial year in recent memory, 2008.
Yeah, 2008. Banks collapsing, markets just cratering, total chaos.
Exactly. But right in the middle of all that wreckage, we found this, well, frankly, exceptional document. It's the 2008 shareholders letter from Fairfax Financial Holdings Limited, FFH.
Mm-hmm.
And look, this isn't just some dry annual report. We think it's basically a masterclass in, disciplined contrarian thinking, how to survive, even thrive.
Absolutely. It's our mission today, really, to unpack how they did it.
Because the results are just, well, staggering when you put them in context.
They really are. I mean, think about it. Stock markets worldwide down maybe 50%, something like that.
Like a bloodbath.
And Fairfax, they post a profit of $1.5 billion after tax.
Incredible.
And their book value per share, it grew 21% in that year. It defies gravity almost.
It does. And what really gets me is the backstory, the context the letter provides. They talk about the 7 lean years before this.
Right, from 1999 to 2005.
Yeah, where cumulatively they made basically no money. Imagine that. Getting criticized probably for being too cautious.
Oh, for sure. Paying out for hedges, for protection, while everyone else was, riding the tech bubble, then the housing boom. The psychological pressure must have been immense.
Yeah.
But then, the payoff. Those 3 years, right after 2006, 07, 08, bang. $2.8 billion in earnings. It wasn't luck, was it? It was strategy playing out.
The ultimate vindication. Okay, so let's dig into section 1, building the arc. How on earth do you get a 16.4% total return on your investments during what they themselves called a 1 in 50 or 1 in 100-year storm?
Well, they have this great line, the Noah principle.
Yeah.
Forecasting doesn't count, building an arc does.
Mm-hmm.
And that arc was all about liquidity and protection.
Okay, break that down. What was the arc made of?
Okay, so the foundation was cash. Loads of it. Roughly 75% of their entire investment portfolio was just sitting in cash and short-term government bonds. Super safe, super liquid.
So they never had to sell distressed assets into a collapsing market.
Exactly, that liquidity was crucial. But then you have the really active protection.
The hedges.
Right. Their stock positions were fully hedged, and maybe even more importantly, they held these huge positions in credit default swaps. CDS.
Insurance against companies defaulting on their debt, basically.
Precisely. This was the big bet against systemic credit failure. And it wasn't free. They'd been paying premiums on these things since 2003.
4 years of paying for insurance that, until 2007, looked like it wasn't needed. That takes serious conviction.
It really does. Imagine justifying those costs year after year, especially when markets seem so stable, almost euphoric. It goes back to that Minsky idea, right?
Stability breeds instability.
Exactly. They recognized that the longer things seemed fine, the more hidden leverage was building up. They were essentially paying for the discipline to stick to their view.
And then came the payoff.
Oh, yeah. When the crash hit, those hedges just exploded in value. In 2008 alone, a $2.1 billion net gain on the equity hedges, another $1.3 billion from the CDS. And if you look at 2007 and 2008 together, they pulled in over $3.3 billion from these protected positions that had cost them money for years.
That kind of cash flow in a crisis.
Yeah.
It explains the balance sheet strength.
Totally. End of 2008, the holding company itself was net cash, about $500 million. Their cash covered all their holding company debt and obligations.
That's not just an arc, that's a fortress.
A fortress built not just to survive, but as a launch pad.
Okay, perfect transition. Section 2. Profiting from the panic. The storm hits, the defenses hold.
Yeah.
What did they do next, late in 2008?
Right, so the immediate crisis phase starts to, settle just a bit, even though the fear is still palpable, and they pivot hard. Well, first, November 2008, markets are down 50%. What do? They remove the equity hedges.
Take off the insurance.
Yeah. The hedges had done their job magnificently. Now they wanted to be exposed if or when things started to recover, capture the upside.
Makes sense. What else?
Second big move, bonds. They sold almost all their U.S. treasuries, cashed out about $583 million in gains there.
Why sell treasuries? Weren't they the ultimate safe haven?
They were, but the yield had collapsed. 30-year treasuries were yielding less than 3%. The thinking was, you're just not getting paid enough for tying up capital there anymore. Risk-reward wasn't great.
Okay, so they sold low-yielding safety. Where did the money go?
Into higher-yielding but still very high-quality debt. They bought $4.1 billion worth of U.S. state, municipal, and other tax-exempt bonds.
Beauty bonds.
Right. Crucially, many of these were guaranteed by Berkshire Hathaway. So, still very safe, but they locked in an average yield of about 5.79%. Big pickup in income.
Smart. Swapping ultra-safe, low yield for very safe, better yield.
Exactly. And then the really bold move, maybe?
Buying stocks.
Buying stocks. In the fourth quarter of 2008, peak fear, they plowed an additional $2.3 billion into common stocks.
Wait a second, though. You said later they predicted a long, deep recession. Why buy stocks, especially financials like Wells Fargo, if you think the economy is heading into a 1930s-style slump?
Yeah, that's the fascinating tension, isn't it? That's pure contrarian value investing. They weren't betting on a quick economic turnaround.
Okay.
They were betting that specific high-quality companies were being sold off indiscriminately in the panic, that names like Johnson & Johnson, Kraft, even Wells Fargo, despite being a bank, were fundamentally strong businesses whose intrinsic value was way higher than the current stock price.
Buying long-term value when everyone else is focused on short-term terror.
Precisely. They state in the letter, for the first time in over a decade, they were very excited about stocks because prices were finally well below intrinsic values. They saw a generational opportunity.
And a shopping list backs that up.
Oh, yeah. Over 7.5 million shares of J&J, almost 11 million shares of Kraft, over 3.5 million shares of Wells Fargo. Big, concentrated bets on quality businesses bought cheap.
That whole sequence, building the defense for years, harvesting the gains, then redeploying aggressively into the panic, it's just textbook.
Textbook, but incredibly hard to execute in real time.
No doubt.
Okay.
Okay, but we need to look at the core engine, too, the insurance operations. Because on the surface, the numbers there looked rough.
Yeah. Ugly was the word they used themselves for the consolidated combined ratio, 110.1%.
And just to remind everyone, the combined ratio measures underwriting profitability. Over 100 means you're losing money on the actual insurance business before investment income.
Right. So 110.1 looks like they were losing about 10 cents on every dollar of premium written. Not good.
So what's the real story there? We need to peel back the layers, don't we?
We absolutely do, because that ugly number was almost entirely driven by, well, a cluster of really big, unusual hits, about $458 million in underwriting losses from these specific items.
Like what?
Okay, biggest chunk. $326 million from Hurricanes Ike and Gustav. Just massive catastrophe losses that year.
Okay, acts of God, basically.
Pretty much. Then you had $189 million in foreign exchange translation losses. That's more of an accounting thing, currency moves, not really about the underlying insurance quality.
Right.
And finally, $110 million tied to a specific large settlement, a commutation and lawsuit deal over at Crum and Forster.
A commutation. That's like settling a whole block of old claims at once, right?
Yeah.
Cleans up the books, but hits the current year's profit hard.
Exactly. It's a strategic cleanup, but it tanks the current ratio. So the key point is, if you strip out those big, unusual items...
What does the underlying number look like?
It was 96.2%.
Ah, okay. So
Yeah.
fundamentally profitable, under 100.
Yes. Demonstrates that the actual day-to-day underwriting, the core business, was sound. It validates their whole philosophy.
Which is...
First in underwriting profit, not in premiums written. They're not chasing market share, they're chasing profitability.
And you see examples of that in the specific subsidiary.
Definitely. They highlight their manager in Singapore, Mr. Athan at First Capital. That unit had an underwriting profit every single year since 2002. Average combined ratio under 90%.
Impressive consistency.
Yeah, and get this. In 2007, they were ranked 4th in premiums written in Singapore, but number 1 in underwriting profit. That's the model. Profit over size.
Got it. And while managing the crisis and the core business, they were still making strategic moves. Acquisitions, expansions.
Yeah, they were busy. They took their Canadian subsidiary, Northbridge, fully private, bought out the minority shareholders.
Was that a good deal for those shareholders?
Seems like it. The letter notes it worked out to over a 20% compound annual return for them since Northbridge went public in 2003.
Not bad at all.
And they were expanding geographically, too. Bought Polish Re to get into Eastern Europe, took stakes in insurers in the Middle East, Arab Orient, Alliance Insurance, spreading their bets.
Internally, management changes.
What's interesting is the stability. Yes, there were successions like at Crum and Forster and in their runoff business, but they emphasized these were all internal planned transitions. Preserving that culture of caution and discipline was key.
Right, makes sense. Okay, so wrapping this all together, looking back at 2008 for Fairfax, the huge profit, the successful navigation, the main takeaway isn't just that they got lucky, is it?
Not at all. It was the direct result, the harvest, really, from years of disciplined preparation, years of paying those CDS and hedge costs when times were good and probably feeling a bit foolish.
Enduring the pain, as they put it.
Exactly. And they connect it to history. They quote Ben Graham.
The father of value investing.
Right. Graham observed that only maybe 1 in 100 investors really survived the 1929-32 crash with their capital and thinking intact. Fairfax clearly aimed to be in that 1%. They had that survival mindset.
And even after this huge success in '08, their outlook was still pretty grim, wasn't it?
Oh, very cautious, deeply cautious. They predicted the recession would be long and deep.
Comparing it
To the U.S. in the 1930s or Japan's lost decade since 1989. They saw massive deleveraging coming across the board, getting rid of debt, a painful process.
So for you listening, the relevance here is pretty clear, I think. Fairfax's success wasn't about timing the crash perfectly.
No.
It was about building a financial structure that could withstand the last 10 years, the good times and the bad. So they had the strength and, frankly, the courage to act decisively for the next 5 or 10.
That's it, exactly. Which brings us to maybe the final provocative thought for you.
Go on.
Despite Fairfax predicting this long, deep, painful recession, this multi-year deleveraging,
Yeah.
what were they actually doing in late 2008? They were out there busy buying billions of dollars worth of common stocks. At bargain prices, yes, but still buying into the teeth of the fear and their own gloomy forecasts.
So the question isn't just, can you build the ark to survive the storm?
Right. The deeper question is, do you have the discipline, the liquidity, and maybe most importantly, the psychological fortitude to then deploy that capital to go shopping when the world looks like it's ending?
When everything feels terrifying.
Yeah. That ability to act decisively against the overwhelming sentiment funded by years of caution. That might be the true lesson from Fairfax in 2008.